Nobody care.
Well, hey, welcome back, everybody. Welcome to the Investor Shed Podcast. I'm Nick Beveridge, your host with the most, here with the second most, Jeremy Kitchen.
I'll settle for second place in this situation. That's A-okay. Hostess with the second mostest, ladies and gentlemen.
You're like the silver, and I'm the gold.
Yeah, I love that. I love that.
I love it, too. Actually, I want to be silver. There's more opportunity with silver.
There's more opportunity, but gold does typically hold a higher value. We've talked about this before, and this is not what the Investor Shed Podcast is about today.
We ramble.
Yeah, but I know we've talked about silver and gold before, but today we're talking about leveling up, ladies and gentlemen. So 2.0 investor strategies.
I've been wanting to do this podcast for a long time.
Have you really?
I have, honestly, not just this morning.
Okay. Like, really? This is the first
But I
time
keep
hearing
forgetting
about it.
No,
Okay.
no, really. I always, I mean, there's so many podcasts out there teach you the basics of real estate investing, and or there's random little topics that they'll jump off on. But I think having a 2.0 podcast, this is specifically for those investors who have a little bit of experience, who maybe have bought some rentals. Maybe they flip some houses and they just want to level up and get some 8 solid tips on what they can be doing to level up in that 2.0 world.
I love it.
What do you think?
I love it. It's going to be a good episode for a lot of people to figure out. Obviously, like if you've been doing this business and you've been doing investing, you're pretty sure what your next goal should be, right? I mean, like a lot of high earners they keep spreadsheets on what they're supposed to be doing, how they're supposed to be performing.
They love spreadsheets.
I love my spreadsheets lately, man.
I like my spreadsheets too.
Yeah.
I have multiple spreadsheets.
I don't have enough spreadsheets, but also like QuickBooks seems to do it's a pretty good spreadsheet for me.
Oh, you just do QuickBooks?
Yeah.
That's not bad. At least you're doing some sort of spreadsheeting.
Yeah.
You're allowing QuickBooks to generate your spreadsheets with your reports.
Yeah. The P&Ls.
We already sound like we don't know what we're talking about.
Oh, good. No, but let's dive into this. So I think this, like you said, Nick, this is going to be a good episode, and prove to me that you've been excited to do this.
Well, I will. Okay, so this is a 15th year in real estate. This is, I think, my 11th or 12th year as a real estate investor. I've done a lot of fix and flips over the years.
Yes, you have.
I've always tried to buy a rental at least once a year or twice. I had 15 rentals at one point, and then I sold off a bunch of them when I was losing a bunch of money building spec homes and stuff. So I feel like I've got a little bit of experience to talk about 2.0.
Yeah,
at least
I agree. You're qualified.
Qualified to maybe at least talk about some 2.0 tips and some things that I learned after my downfall that was really helpful to like get me back in the game.
Yeah.
And I feel like things are running a lot more efficiently these days for maybe the last year or two.
Right.
I'm profitable on a lot of my flips and rentals now.
That's awesome.
And a lot of it has to do with the tips that we're going to go over.
Cool.
So I'm excited to share.
And before we get into it, I do want to say, I've said it before, I'm proud of you for how you've bounced back.
Well, thanks. It's a rubber ball.
It is a rubber ball.
It's not a glass ball like your family.
Thank you. But it's like a rubber ball still needs to have that force in order to be bounced back up.
Yeah, or you can kick it and it'll bounce.
Let me give you
it's a rubber ball.
Yeah, because it's a rubber ball. Yes, no, like a lot of people would have quit when they were down. You did not. Like a lot of people would have said like, wow, I'm in way over my head. This sucks. I don't know if I ever want to do this again. It would be easy for somebody to just be like, thank you, sir, and bow out.
Yeah.
But you did not. So props to you, and you're still here, and you're still kicking ass.
Well, thank you. Half of that was I felt like I didn't have a choice.
Well, that's great. That's a good mindset to be in, honestly. But
yeah. And fortunately, I was in real estate, so I had a lot of rentals with a lot of equity that was able to help me get out of the situation.
Sure.
I just had to do the dirty thing that I didn't want to do, which was sell, drill, baby, drill.
Drill, baby, drill.
All right. So tip number 1, for all y'all out there that have a portfolio, take a look at it. Take some time, stop doing new deals, and just, analyze your cash flow situation on these properties, your return on investment, maybe the appreciation that you've gotten on your rentals, see what kind of equity you have there and the return on equity that you may be getting with your cash flow, and see if it's meeting some sufficient benchmarks that are good enough for you.
Right.
For me, I like to at least be over 5% return on equity.
Okay. What does that look like?
Sure.
Yeah. Break it down. So that means, like 5% year over year, your equity goes up. Is that kind of?
Oh, so for instance, 5%. So let's say I have a rental property, a house that, let's say I owe 200,000 on it and it's worth 300,000 and it's bringing in some cash flow around let's say $5,000 per year.
So you've got 33% estimated equity in this scenario.
So $100,000 in equity
Mm-hmm.
for simplicity. And on that $100,000 on equity, I'm making $5,000 in cash flow annually.
Gotcha.
That would be 5%
Gotcha.
or more.
Yeah.
So I think that's a pretty good benchmark. Let's say if that was negative.
And we're talking cash flow. We're talking money over what your actual mortgage is, correct?
Yeah.
Okay.
Not just, I mean, just
Not just paying the mortgage, like $5,000 extra on top of.
well, some of that mortgage is going towards paying down the debt.
Right. Of
So
course.
you got to actually take out your principal payments when you're calculating this.
Okay.
But your true, like, how much is that house putting in my pocket or equity
Gotcha.
by principal pay down
Sure.
or strictly cash flow
Gotcha.
annually? And am I good with this? Or can I get better returns with this $100,000? If I just sell this property,
Right.
can I get better returns than 5%? Now, you also got to consider with real estate, your tenants are paying off the house. Eventually, you're going to get more than 5%.
Right. Yeah.
Because eventually the mortgage is going to go away.
Mm-hmm.
And then you've got tax benefits that go along with this
Sure.
that could increase that as well. But strictly, is it worth the hassle of owning a rental property with all the baggage that comes along with that? Because there is baggage.
Yeah.
You got, not everything can just be done remote, with a property manager, and you never have to even think about it.
Right.
There are still things that come up where you have to deal with stuff.
Sure.
Is the mental baggage worth that? Because you're going to obviously get your returns plus more with the other benefits of appreciation,
Right.
principal pay down, tenants paying down your loan,
Right.
and all that stuff. But you got to figure out what your benchmark is, and is it worth it?
Yeah.
A lot of the times, if let's say that same property, if it was netting zero, but it was paying for itself, and you had $100,000 of equity there, you'd be surprised. There's a lot of investors that are like, hey, at least I'm breaking even.
Yeah.
I'm doing well. I'm saving on my taxes.
Yeah.
But I mean, could you do better with that $100,000
That's important.
and make a better investment where you're actually cash flowing?
Right.
That's what you got to look at.
Sure. And I mean, obviously, there's other factors to include in this. Like, so if you sold this, obviously, you're going to have realtor fees, type of thing like that. Closing costs. So, I mean, your $100,000 could potentially be like 6%, or your whatever equity you have. Could be potentially 10% less of that, right? Hypothetically.
Sure. Yeah. So I'm just doing rough numbers
course,
here.
But just it's important to know these numbers if you are going to be going to do these things and sell these things in order to buy another asset, right?
Right.
Yeah.
And it would actually be, I'm sorry, even more than that, because the selling price of a property like that would be $300,000.
Right.
And then, the selling costs could be as much as 10%.
There's
If you
$30,000.
calculate commissions to agents, title and escrow fees, depending on what state you are, there could be excise taxes. There's also, selling in a market like this, a lot of buyer incentives that you have to offer, like concessions for their loans. So you can just kind of take 10% off the top.
Yeah.
So that's $30,000. So if you think you have $100,000, and if you sell it, you might actually only have 70.
It's true. Again, that's just something I want people to be aware of.
So you
right?
brought up a good point there.
Yeah, like, I mean, obviously you reevaluate, but like reevaluate with these numbers in mind. Like, if I sell it, what costs am I going to have to hypothetically pay? And I'm sure there's a spreadsheet out there, speaking of spreadsheets, that says like, how much are my closing costs on my house?
Yeah.
And you put in your house value and it'll probably tell you.
Yeah.
But just keep that in mind, right? So if you are going to be selling, there are going to be additional fees associated with that. So, maybe your $70,000 could still make you a better investment though.
Yeah. But the whole point of tip number one is just to evaluate and know where you stand with your current properties that you have. Because some investors are in growth stages usually when they get into this. And for the first, 2, 3, 4, or 5 years, they're just acquiring properties. They're trying whatever they can. They may be buying creatively, whatever they're doing to buy properties. And then they get to a point where they can relax, look at what they have and see, how am I actually doing? Now that I've had some time for this real estate to, have a couple of years of tenant history.
Yeah.
They could be horrible. They could be great. You never know till you give it some time.
That's true.
So ideally, if you're in this situation, your rentals that you have, they have a couple of years of experience to kind of give you an idea of how to protect the future.
Sure.
And what to anticipate going forward.
Yeah.
So second tip, maybe consolidate and streamline your holdings.
Okay. What do you mean by that?
So we've had the opportunity on this podcast to interview a lot of seasoned agents, way more seasoned than us.
True.
Some people with, 30, 40, 50 years I think we had a 50-year experience person, didn't we?
Probably. I mean,
I know it was mostly 40s.
yeah. 40 seems like a good number.
But a lot of them seem to have the same kind of advice. You know, they got in, they bought single family, small multifamily. They did all kinds of stuff, whatever they could. Over the years, they built this big portfolio. They got big, they got small. A lot of them seem to agree that if they had to do it all over again, which was surprising, a lot of them just would focus on small multifamily or apartments and kind of stay away from single family. If they had to do it again. But it was the single families that kind of got them to that point. So it was a lot like the Monopoly or, the
everyone needs a starting point for this thing, right?
A lot like that game Cash Flow, where you kind of make a lot of your big chunks of money, maybe flipping houses or buying rentals at a good price point that cash flow for a little bit, and then you sell them at the right time.
Yeah.
And you have bigger cash that you can reinvest. But that seemed to be a reoccurring theme with investors that have been doing this a lot longer than us.
Yeah, for
when we've
sure.
interviewed them.
And this is a pretty common theme, of course. Like, we're not like reinventing the wheel with this, but again, a lot of investors start with single family homes because they're easy to get into. Cost of entry is less. Once they get big enough, you'll find a lot of investors say that like it's just much easier managing 10 properties in one house. It's one roof to worry about.
Yeah.
It's one heating system to worry about. You know what I mean? Like,
pretty much.
It makes it so much easier having all these problems consolidated into one spot versus like, oh, I've got, a rental in Hayden and I've got a rental in Post Falls and then I've got one in Kellogg and they all need something today.
Yep.
But
yeah. So, I went through, that rough time 2-3 years ago. And I realized, I need to start selling some properties because I've got a couple $1 million worth of debt here to take care of.
Yeah.
Not kidding, by the way, if you haven't heard my story in the past. Literally a couple $1 million worth of losses that I had to anticipate. Where's this money going to come from?
Yeah.
Fortunately, I had 15 rentals at the time. And what I did was I looked at them logically, as without emotions, and just all on a spreadsheet, and saw every single item. What is the loan on this one? What's the equity? What's the interest rate? What's the current cash flow?
Yeah.
All that. And I was able to select a lot of the properties that I loved the most and sold those.
Yeah.
Because maybe they look great. They didn't have much cash flow. They had a decent amount of equity, but I went ahead and I chose properties that cash flowed the least or had negative cash flow.
Yep.
And I sold those first.
Yep.
And then I wound up with, I sold 10 properties over the course of a couple of years.
Yeah.
And now I have 5 or 6 right now. I don't know why. I don't know if I have 5 or 6. I think I include my personal property. But anyway, so today I'm left with, I've got a fourplex that always cash flows very well.
Yeah.
And it has its own bank account and its own LLC.
Yep. We'll talk about
now.
that.
We'll talk about that later. I have an RV park, which I finally put some effort into, got it cash flowing. Now that thing produces the most cash flow out of anything.
I love it.
Surprise. It's an RV park.
Well, yeah,
a lot of management.
That thing was such a problem
but
for a while.
I wanted to sell it when I didn't have the time to put proper management in and take some time to massage it.
I just remember that thing was bleeding you dry for a very long time.
Dry. A couple $100,000 worth of just nonstop, and then we were dealing with homeless people,
improvements, payments, or vacancies.
It wasn't a great situation until I got it managed correctly.
Yeah,
talk about that later.
Cool.
But and then there's about 3 other houses that I have.
Yeah.
So I wound up with 5 investment properties and my personal house, and then some land. So 7 properties total. But I decided to keep those. And I noticed that I had even more cash flow come in than when I had 15 properties.
Isn't that weird?
Yes.
Yeah.
And life started getting easier, less to manage. I kept the good ones, and I was able to reinvest a little bit of money into these ones that I had to make even further improvements, and the cash flow even better now.
I love it.
So less is more sometimes.
Yeah, absolutely.
But that came from reevaluating the portfolio in step 1.
Right. So we went from step 1 to step 2, clearly.
Step 2 was deciding to sell some stuff.
Right.
And use the cash for better items and paying off other debts and that kind of stuff.
And that's definitely a 1-2 punch with this 1-2 strategy, of course, but reevaluate, make sure your rentals are serving you in a way that makes sense. If they're not, you can sell. It's not the end of the world. And you're not a bad investor if you sell a property. Some people have, like seller's remorse, of course, like, oh, I shouldn't have sold that. But, whatever you've done has brought you to this point right now.
Yeah.
And you're thriving right now. So it's like,
for now,
mentally, and like you seem like in a much better mental headspace than you were 2 years ago.
Oh, for sure. And I have a lot more time on my hands.
Right. So that's definitely a win-win.
Yeah.
Very cool.
So number 3 is building a bulletproof team. You can speak on this.
Can I?
A little bit.
Wait, okay, I'm listening.
What?
No, I mean, I think everybody gets to this point in business where like leverage kind of becomes a necessity, if that makes sense. And in order to build a bulletproof team, you're really looking for A-list players to complete the things that you're not good at.
Yeah. So in real estate investing 1.0, they say build a team.
Right. Just get somebody.
In 2.0, you need to continue building that team and make sure it's a bulletproof team of rock stars.
Fine tune this.
Because at this point, once you have this much experience, it's okay to venture off. If your manager isn't doing it for you, if your property manager isn't doing it for you, if your real estate agent maybe could be a little bit more wise, your contractors, if they're not showing up every day, it's okay to continue to look for better people.
Cut the bad fruit off the tree.
You're only as good as your team in most cases. And if you've scraped and got everything you have, in spite of your, let's say, entry-level team, just know that the A players work with A players. Hey, quick commercial break here. Thank you so much for listening to this podcast. I really do appreciate it. If you want to give back, let me help you buy a house, or I can help you sell a house. It's the only way I make money when I'm not investing in real estate. I don't make money on this podcast or the events I do, but I do make money only when I help people buy and sell houses. So if you're looking for your next investment and you're here in North Idaho, I want to help you personally. If you are not in North Idaho, I can still help you out. I have a vast network of referral partners all across the country, and I can find the right real estate investor savvy agent for you so you don't have to. It doesn't cost you a thing. Thank you for your support. Back to the show. And you got to level up your team as well.
Yeah. And C students work for A students. Or A that's what Robert Kiyosaki says.
A students typically work for C students, and B students work for the government.
Is that how it goes?
Yes.
Oh,
that's
okay.
that's in that book.
Okay, I haven't actually read it. I have it.
Oh, I've read it.
What book are you reading right now, by the way? I'm sorry to...
I think we mentioned this in the last podcast, dealing with the changing world order.
That's right. Okay.
Yeah. Principles of dealing with...
Principles.
Principles of dealing with the changing world order.
So yeah, build yourself a bulletproof team here. I think this is a very crucial part, honestly. Just having the people around you that can help you get to that next level.
Yeah.
That are forward thinkers, that are creative. Having a lot of visionaries on your team probably isn't a bad thing, unless you need integrators. Like, just figure out what you need again and build out who you want this to be without you having to do the work.
Yeah. And that doesn't mean you have to completely abandon if you really like your real estate agent, but they're just not bringing you deals. Maybe just ask for, maybe they can level up. Maybe ask their help. Just say, hey, I'm looking to do more deals this year. Do you have time to help actually try to find these types of deals?
Yeah.
And would you be offended if I maybe talk to a couple other agents too, or,
Yeah.
And whoever brings me a deal gets to work with me.
Sure.
On that deal.
I think with this, like building a bulletproof team, I think it's important to throw your ego aside if you have one at this step.
Yeah. Or build one.
Yeah. Or build a better ego.
Inflate your ego.
Yeah.
But don't make it obvious.
Yeah. You don't want to be obvious and pompous prick, but yeah, definitely know that like together we all win. And if you can have that mentality of like, okay, I can help these people grow and they can help me grow, and we can actually create a win-win thing here, that's going to be very beneficial for everyone involved.
Yeah.
And take care of your team too.
Take care of your team, take your time, and never stop building your team, because like you're always going to have team members coming in and out of your lives.
Yeah. Make sure to take your team members on boats.
Oh, yeah. Big mistake there.
There's no mistake. I'm messing with
Okay. Tip number 4, systematize everything.
I like it.
Yeah. So this goes beyond just using QuickBooks. But use QuickBooks if you're not using QuickBooks.
That's like step 1. Like I'm on step 1 of this. Like QuickBooks, make sure you have some software that tracks your spendings.
If you're flipping houses, it's going to be really helpful to not show up. Like I'm astonished lately that I've been able to flip a couple of houses and I don't go there anymore. But I have pretty clear expectations with my contractor of what to do. And I've enabled him to just talk to just hook him and the Lowe's manager up.
Yeah.
If you need any materials to make it even easier on this contractor, he doesn't have to go to the store.
Right.
He could just talk to the Lowe's manager that's dealt with my account, and the Lowe's manager can have stuff delivered that day or the next day.
I love it.
Make things easier on your team too.
Right.
And that's just one little example, but I mean, try to have systems for everything you're doing on a regular basis, even when it comes to just getting the mail and putting it on your desk, and how do you deal with that on what days.
Yeah.
Start building a routine around everything, and you'll be able to get more stuff done the more you are very predictable in your nature of how you handle everything.
Sure. Yeah, I like it. And with systematizing everything too, like you're freeing yourself for other ventures without being bogged down by the systems and processes. So, build out your SOPs.
Yeah.
And, we talked about this on previous episodes too. Just like say everything you do in a day and just like write it down, or have somebody write it down and shadow you. Like, okay, like what does your day look like? Okay, Nick gets here at 8, he checks his email, he goes here, he goes to work out, he handles all these things, and then it's up to somebody else to be like, okay, how can we help optimize this day for Nick, right? Maybe somebody else opens his emails and somebody else does his correspondence. Nobody can work out for you.
Yeah, dang it.
That'd be cool. If I can outsource that.
Cool to hire that out.
I'd love to hire out somebody to eat healthier for me.
Yeah.
Just like somebody who like they can eat a salad and I get the benefits.
Yeah.
That'd be nice.
But to give more examples, automate and systematize as much as you can, because as you grow rental properties and as you take on more and more business, you're going to get bogged down by things that could easily be automatized, like things as simple as like automatic bill pay.
Yeah,
for every little thing. Make sure like every bill that you get, is there an option to automate this?
I love it.
And if there's not, is there a way you can automate it on your own bill pay by just like sending, having your bank send a check to something every month. Take every one of those little tiny micro distractions that will happen every month,
every day,
and figure out how to make that automatic.
Yeah.
And I know we're just talking about bill pay.
Right, but this goes so much further.
But there's a lot of people that don't have automatic bill pay set up on everything. Maybe because they feel like they don't have enough money.
And that's the thing too.
They have to double check. So that's, but that's typically a problem that when you get to the 2.0 level, it's not as much of an issue,
right,
as when you're just starting out for the most part, but you should have a little bit of money by now.
Yeah.
And now it's about organizing yourself well to where you're not going to have issues where you have to even think about utilities,
right?
Like paying the utility bills.
And I mean,
it should all be automated.
Think about it. Like, I don't know how much do you actually pay bills every month? Do you have to go in and be like, oh, I need to pay this and I need to pay this?
It used to be a lot.
Yeah.
Because when you have, 20 properties, that could almost be a full-time job if you don't automate it. But
absolutely,
if every time you get a new property, if you just set it up once and forget it, you should be fine.
Yeah.
And assuming that it's coming out of the right account where there's going to be sufficient funds to deal with that.
But definitely make sure if you do this and you're at the beginning of your automation, make sure you check your accounts every now and then to make sure. Sure. We've had that problem before. We're like, oh yeah, we're getting paid on our rental, and we weren't.
Yeah, that was unusual.
Yeah, and that's okay. Like,
but it happens.
Stay on top of it. But like, we could have had an accountant, we could have had somebody doing this, but we just didn't. And that's, I mean, at the end of the day, that falls on us.
Yeah,
and that's okay.
It didn't go negative though. It just had less money than we thought.
A lot less.
A lot less because we weren't getting full rents.
Right. We weren't getting any. Like,
partial rents.
I looked at the account and I'm like, what happened here? Why are we not making monies? But a thing I've heard with this particular situation is automate, delegate, delete. Have you heard that?
Oh, yeah.
Yeah. So automate the things that you can get rid of quickly, delegate the other things that you can give out to other people, and then delete the things that just don't work.
Yeah. And part of this is like if you're at this point where you have a lot to manage and there's going to be plenty where you can't just automate everything and you're doing routine admin tasks, $10 to $20 an hour task every day. And if you want to, or you want to focus on other things, maybe this is the time to get an assistant.
Yeah.
Part-time, a remote assistant, virtual assistant. There's so many options out there these days in 2025. Yeah. To get help leverage-wise on these kind of items. So if you're not there, if you consider it, there's so much. I even, in my real estate business, we have Sabra, but it's amazing having someone like Sabra.
Yeah, of course.
To just unload on when you have a lot you need to get done, you need help.
Yeah.
Or if it's, anything you can imagine that if somebody else can do it, that's not you, can you hand it off to somebody?
Sure.
And just focus on the actual, high dollar
Yep.
income items.
Yeah.
That's what I try to do.
Cool.
Did a butchering job of describing that, but getting an assistant can help.
Yeah.
It can help a lot.
This kind of goes back to building a bulletproof team, honestly, because if you feel that you need a bookkeeper or assistant or something like that, like now is the time to do that.
Yeah.
When you're in growth trajectory mode.
Yeah.
Right? Like I'm heading towards growth. I'm going to be overwhelmed.
And I'm going to put out a weird opinion about bookkeeping. I really, in my experience, and being where I am and knowing if somebody else is in my shoes,
Yeah.
I would highly not recommend having a bookkeeper full time.
Sure.
Because we have QuickBooks.
Right.
And essentially QuickBooks is a bookkeeper.
Right.
And the bookkeeper's only as good as the input that you give it.
Right.
So you can give the stuff that you're doing to a bookkeeper to put in QuickBooks.
Right.
Or you could just automatically put it in QuickBooks quicker than you can give it to a person and figure out how to use these tools and how to use QuickBooks. Maybe have a bookkeeper teach you how to use it.
Right.
Or somebody, watch some videos.
Yeah.
But in my experience, I've had both. And it is far easier for me just to work with QuickBooks directly instead of having someone in between me and QuickBooks.
Sure.
Because QuickBooks is it's the bookkeeper. It's the automation it's 2025.
Right.
It can really, in my opinion, I could be wrong.
Yeah.
But in my opinion, it does 90% of what a bookkeeper does. The 10% is that they get items from the business owner of what to input.
I think it's definitely situational.
Yeah.
Whether you could use one or not. I do not have a bookkeeper. I have QuickBooks, but like there are times where I'm like, I feel like I need help with QuickBooks because like I'm in over my head and I don't have the time to learn it. And that's when I'm like, maybe I should hire some of this stuff out and just like get it off my plate because taxes are very important and making sure that you're doing things in the correct
taxes
way.
are different.
Yes.
Taxes are different. I'm just talking about the daily, keeping up with your P&L on a weekly, monthly, annual basis.
Sure.
And, figuring out what expenses were for what. And just routinely analyzing that. And by doing so, you'll have a much better grasp on your financial situation and each house that you're dealing with. Because if you completely step away from that, you may not know if one of your properties sucks.
Right. That's true.
Unless you're the one actually inputting the books and you can see where you stand with that on a monthly, annual basis.
But that's also...
It's very easy to hand all this stuff off.
Right.
Which takes almost as much effort to hand it off as it does to do the QuickBooks, is what I'm trying to say.
Sure. Yeah.
It takes almost as much effort
I get it.
to meet up with a bookkeeper. It actually takes more effort, in my opinion, and in my experience, to meet up with a bookkeeper, to hand them all your crap,
right,
than it would be just to categorize everything that's on QuickBooks, because it should all automatically be going in there anyway.
Right.
Everything that you're spending.
I will say it's easier to manage QuickBooks when you're on top of it.
Yeah, like but you should be on top of your finances.
You should be, yes.
What I'm saying, I don't think it's a good idea to be ignorant or to play. This is something I don't think it's something you should offload, but it's just my opinion. I could be totally wrong.
Yeah, and I respect your opinion either way on it, and I don't have a strong opinion for or against. I'm just saying, like, for me, it feels like when I'm on top of my QuickBooks is when it's nice, but then when I fall behind, I'm like, shit, I don't know where any of this stuff's going anymore, like what this receipt was for, or how to categorize it now that it's been 6 months and I haven't looked at the damn thing.
Yeah. And maybe part of my theory is like, if you have if you just don't want to deal with it and you want to have a bookkeeper do it all, what was the point anyway? Right. The whole point of doing your books is to get reality checks. Yeah, on a regular basis, monthly, annually. So if you're never even going to look at your books, what was the point of somebody else doing it?
Sure, it's nice.
Might as well just at the end of the year do your annual bank statements, income and out, and say, here you go, tax guy.
Right, make it a pain in the ass for your tax guy.
Yeah. Well,
which you don't want to do. You want them to kind of like want to work with you at the same time.
I know. I'm just saying if you want to be completely out of it, maybe I just don't think that's a good idea. I don't think that's
totally fine.
a good idea to not know what's going on financially in your business.
Do you think, and I mean, like, this could be something either a bookkeeper or an assistant could do, but like, if you find one of your businesses is failing or you need money here, they're like, that's something that they could flag you and tell you at the same time, right? Like, hey, by the way, you haven't gotten any rent for this check in 3 months, or hey, we haven't gotten any receipts on this flip you're doing in 6 months. Like, they can keep you on top of it too, which is nice. It's an extra way to be on top. But again, like you said, like, I don't think it's necessary for people to have a bookkeeper. I would agree with that.
If you're doing real estate investing 2.0,
right,
and you've got a few rental properties,
but it also depends on your books.
It
and
depends
the portfolio.
on depends on everything else you're doing.
Yeah.
So yeah, I agree.
Yeah.
Okay. So moving on, refinancing and optimizing debt structure.
I love it.
So this could be also a good idea. I mean, before step number 1, we're just looking at how are the properties doing.
Yeah.
Now we're looking at how's the debt doing.
Right.
And could I get any better deals? Like, let's say I got a hard money loan on a property 3 years ago, and it cash flows like crazy. Never even think about it, and it's still, it's just interest only.
Yeah.
And you kind of forget about things like that sometimes if you're an agent or you're an investor. And maybe it's time to look at all your loan structures and be like, oh, this one has an arm and it's coming due in 3 years. I should really figure out, I should plan on refinancing that thing.
Yeah.
Do you have
within
the next year? I do actually have one.
Yeah. Looks like you've got 2.
An ARM is an
adjustable rate mortgage. I'm messing with you.
You're so silly.
So you have one with an arm on it right now?
Yes.
Okay.
Yep. One that I got, it was on that fourplex.
Okay, cool.
And it's at I think it's at a 4.75 interest rate. And it's a 30-year amortized loan.
Okay.
But it has a 10-year arm. So the rate is going to adjust at 10 years, which would be in 2028, I think.
So at that point, and I apologize here, I'm going to ask the question because I don't know how that works on the back end. I've never had an arm switch into a non-arm. So you have an arm, it's on a 10-year mortgage, but it's on a 30-year mortgage, but a 10-year arm.
Yes.
Okay, so after the 10 years is up, does it default to whatever the rate is, or did you agree to...
The rate will adjust based off what are the current interest rates.
Gotcha.
And it can only, if I remember right, it can only go up like a full percentage point per year. Okay. So there's some caps. It's not just going to shoot up like crazy.
Sure.
Because like it's a non-owner occupied investment loan.
Right.
Those loans are hovering close to 8%.
Yeah.
Which is almost double the interest rate. Because right now on this fourplex, my payment on it's like $1,900, which includes taxes and insurance.
Pretty good.
And the cash that I get in at monthly is close to between $4,000 and $5,000 a month.
Yeah.
But I know that this is a ticking time bomb, and I have to look into that here and there. And remember that, hey, I've got 3 years of this magic interest rate. It will go up, and I just got to plan for that.
Sure.
There's another property I have where there's a 12% interest rate, interest only. I'm still cash flowing on it. Yeah. But I'm like, man, I really got to take care of that at some point. Right. Because it's not a long-term solution. This is a Band-Aid. Right. And eventually I got to do some stitching on this cut.
Sure. Yeah. Eventually I got to go see a doctor.
But it's a good time. In general, I don't have a lot of good examples for me personally, but this is part of 2.0 is optimizing your debt structures and making sure that do you have long-term fixes for each one of your properties or a plan to eventually refinance, or should you have to sell? Is this going to be one of the properties on the chopping block based off the financing? Sure.
Yeah. And it's very important to be aware of this. Like I said, you've kind of got it together where in 3 years, your arm's coming due, your arm's going to be fixed. Yep. So like, all right, you've got a little bit of time to make a plan for that.
Yeah. And the plan is to increase rents. Yep. Over time, over the next 3 years, slightly. Yeah. And just anticipate that rate going up for that year, and then the next year, who knows? Even if rates come down, that interest rate's still going to go up. Sure. Because I know
because you're so far between.
There's such a gap. So you just got to be aware of this stuff.
Yeah, absolutely.
Okay. Level up on your asset protection and legal structure. I bet you we can talk about this for a while. We had a whole episode about it.
Yeah, we've had a whole episode about a lot of these things, actually, but it's nice to have it kind of compressed into one game plan for you as well.
Yeah. So this is something that I really got into in a year ago. It's about a year ago is when I started messing with all my stuff, because I got to a point where I was like, finally, I sold the big development I was working on, got a bunch of cash, was able to finally pay off all my big debts.
Yep.
And I was in a position where I had a lot more time on my hands. All of a sudden I had cash flowing properties, a few of them.
Yep.
And most of them were owned in my personal name.
Sure.
For financing purposes to get the loans. The other half were just in one LLC.
Right.
I had no trust set up. I knew that was something we always preached but never did.
Right.
Something, shame on me.
You don't know until you get to that point. So like,
it's always in the background. Like, one day I will get all this stuff set up, but like one day will come when it's too late.
It's true.
So might as well jump on it as soon as you're able to, which is never going to be the right time. So just do it.
Yeah, absolutely.
You're never going to be in that, this is the perfect time to do this situation. I don't think, because I even have excuses back then, but I had to block off time in my calendar to get it done.
Right.
So if you don't already have a trust, just know that the trust is for estate planning. It is not for any liability protection.
Yeah, or asset protection, right? Yeah.
Asset protection. Yeah, sorry.
Yeah.
So it's not asset protection. That it does have some incognito cool effects where maybe people don't know exactly who's the owner.
Yep.
But it doesn't protect you legally.
Right.
If you get sued.
Yeah. It's still, I mean, like, we'll talk about this later, but like the piercing the corporate veil is kind of something that comes to mind when we're talking about asset protection, and that's not what this is.
Yeah. But for estate planning, it is a miracle drug for your estate planning.
Yeah.
It is simply just a document that even ChatGPT or Grok can write up for you.
Yeah.
I would recommend, we use KKOS lawyers, KKOS.
Yep.
Matt Sorensen's company.
And Mark Kohler. Mark Kohler came first. KKOS. Sorensen is at the end. Make sure you give the man some props. They're both
Mark has more subscribers.
Does he?
Oh yeah.
Oh wow.
You didn't know that?
I didn't.
A lot more.
Listen to both their shows.
But I like Matt's content a little bit more.
Yeah, they're both pretty good.
Yeah.
They're what I want to
We're talking lawyer talk here.
Yeah. They're both they have a podcast, two podcasts actually. They have Main Street Business, which if you haven't listened to it, it's different than our podcast. It's mainly just like business tips.
Yeah.
How to get tax sound, how to save yourself from being sued, how to do these things, how to set up a 401k. Like, we don't offer that stuff.
Yeah. But the cool thing about this attorney's office, and we're not affiliated with them yet. Maybe one day, but
I'd love to.
They are experts. They know how to work with real estate investors.
Yes.
They know exactly what real estate investors need. They know how to model them for the absolute best protection that I've ever seen. Yeah. And they're cheap. Investors' favorite word.
It really is.
They're cheap because they do so much volume. They're able to be. So I know if I were to go set up a trust here locally in North Idaho and deal with lawyers that do it once in a while, it's going to cost $5,000 to $6,000, and they're going to do a horrible job, and they don't really even have good advice most of the time because they just don't deal with it as much.
Right.
These people, they do like hundreds a day.
Yeah. Like, they specialize in this specifically, and they specialize in setting up, like, turning your business from an LLC to an S corp.
Yeah. And they can set up your full functioning gosh, what kind of trust is it? Revocable trust, sorry.
Revocable living trust.
A revocable living trust for like $2,000.
Yeah.
And sometimes they have specials where it's less.
Yeah.
A very small price to pay for what you get.
What I honestly love about working with them is, like, I always get the one that's like, I have an attorney consult built in for like an extra $300. I'm like, dude.
Oh, and with that, you get to talk to an attorney for like an hour.
Yeah.
An actual timed hour, not where it's just like in 30 minutes you're done, but like, hey, you have another 30 minutes, so we can talk later.
Yeah, exactly.
If you have more questions about real estate in general or real estate asset protection, it doesn't just have to be about the trust.
Yeah. No, they're very easy to work with. I have them for my, not KKOS, I have the Directed Trust Company, who's their sister company for my IRA, of course. I just recommend them. Like, they are the tax and legal professionals as far as like getting entities set up in the game. Yeah.
So they will help you set yourself up as if you're a billionaire and you have parts in your business that, A players would have to just mirror what they do.
Yep.
Where you're not completely invincible from getting sued, but you're pretty damn strong.
Right.
Got a lot of shields.
Any defense attorney or any prosecuting attorney that's going to go into your stuff and be like, okay, how can we get money from this guy? Yeah. And they're going to see a complete legal structure that's like a pyramid that you can't actually penetrate. and they're going to have a hard time.
Not worth penetrating.
Not worth penetrating. Yeah,
Yeah.
exactly. And there's nothing's impenetrable, but you set up these defenses in order to give yourself the best option at protection.
Yeah. So to give you an idea of what I did and what I was kind of taught was all the properties that I had, any of them that I had like 200 to 250,000 or more in equity. So if I had $250,000 in equity in some real estate or more,
In one LLC.
Yep. I would put that in one LLC, not a Wyoming LLC or anything like that. Operating state that you're in. So we're in Idaho.
Yep.
Have an Idaho LLC for that. I am a manager, not a member of that LLC. And you can, if you already have existing ones, you can just change the operating agreement with minutes and addendums.
Yeah.
So if I have one or two properties in that LLC is then owned by not the trust, but by a Wyoming LLC holding company for the rentals.
Yep.
So if you have rental properties, you typically want your whatever state you're operating in. Again, those are owned and divided based off equity. So if you have, like, I have that one fourplex that's got like 400 grand in equity almost.
Yeah. That's got to be in its own LLC.
It's just its own LLC. I have another couple of houses that they share one LLC. And there's only between the two of them, maybe 150 grand worth of equity. I got the RV park in its own LLC. I've got another property with a partnership in its own LLC. All those LLCs are then the new member is a Wyoming LLC.
Gotcha.
And that will give you charging order protection. So if you personally get sued, it's going to be impossible to basically get money forcibly by selling any of these assets. So it protects your assets from you. The Idaho LLCs protect the assets to be contained with the liability within that LLC.
And that's very important, right? So if
you
somebody
can still
wanted
get
to
sued.
You can still get sued, of course, but it
would just stay within that equity. So that equity there is at risk.
Right.
And that's why you want to limit the equity and not a number of properties or anything like that. It's specifically how much cash, money.
Yep. What's your equity position in this LLC? Correct.
And that's what's at risk.
Yeah, exactly. So, and that's why, like, when you have these different LLCs, it mitigates that risk, knowing that, like, okay, you have two properties in here that have $125,000 in equity. One of those properties, say a tenant falls and breaks his leg down the stairs, sues the LLC. The only thing that they can get access to is that 125 if they go to court for it.
Right.
None of your other properties are subject to any of it because it's a completely separate entity.
So if you've just spent 5 years or a decade building up this big portfolio of properties, and let's say you're worth $5 million, not hard to do after a few years in this business. Your risk is limited. It's not like, okay, one day I'm going to get sued and lose it all. One day you are going to get sued, probably.
Yes.
But you can limit your risk. It's called a limited liability company because you can limit it as in that particular LLC. Just make sure it's structured correctly.
Yeah.
And then if you personally run over somebody in your car, that Wyoming LLC will give you some charging order protection for them not to go after. They can still try to sue everything, but they can't force a sale.
Sure. I love it. And what's funny is, like, I was listening to Mark and Matt yesterday when I was on my drive, and I'm like, you know what I should really start carrying with me just in case is
gun.
That too. But release of liability waiver. So if I go to a house, and this happens pretty often, where, like, somebody's like, hey, can you help me move this couch? Hey, can you help me do this real quick? And it happens again a lot. Like, if I ding their house, like, I'm susceptible to damages.
Yeah.
So, like, I'm happy to help people, but I need to be like, hey, I'd love to help you. I'm not a professional mover.
Yeah.
I would like you to just sign this release of liability thing that says I'm not liable for any damages.
And then they're gonna be like, oh, no, thanks, I can get it. Great. But if they do sign it, then you go to your car and get your sledgehammer and be like, you said I can't now get sued.
Yep.
And then you start smashing up their house.
Yeah.
Make a good video. Okay.
Yeah. No, but, like, I thought about that. I'm like, because I don't want to get sued for something little like this. And just having those little, like, yeah, of course I'll help you, but would you mind signing a release of liability waiver? So, yeah, I think a lot of people would understand, but
yeah,
we'll figure it out.
So that's, like, kind of the basics of the legal structuring. There's more to it than that. There's types of insurances and stuff that you can use. I have umbrella insurance as well.
Covers all your umbrellas in the case they break.
Yep.
Yep.
So I've got insurance, LLCs, and trusts, and I got it all set up in a way to where I can just sleep better at night.
Yeah.
Knowing if I do get sued, I don't have it's gonna happen. At least I'm doing the best I can.
Right. And umbrella coverage.
To limit losing a bunch.
Umbrella coverage, just for those of you who don't know, is say you have all these protections because you have other insurances other than umbrella insurance. So umbrella insurance basically just covers, from what I understand, everything that your policies don't cover, correct?
It goes beyond. So if let's say you get sued for $1 million, but you have on this property that the tenant slipped and fell, your policy only covers $300,000.
Yep. Okay.
So your insurance is going to cover it. You know, they slipped and fell, but you're responsible for this other $700,000.
Right.
Your umbrella, if you have $1 million umbrella policy that, you know, is covered under multiple different, and you got to keep up with this umbrella policy too.
Yeah.
Let's say, okay, well, I've got an umbrella to help me with the rest.
Yeah.
$1 million that covers these, 6 properties.
Sure.
So that's how you can also try to save a little bit of money too. You don't have to, I need $1 million of liability on each property. Right. Maybe you can have a small amount on each property to save your, and this is part of the 2.0 and managing your expenses. How can I play with insurance to where I feel comfortable if something happens here, I'm covered over here too.
Sure. Yeah. One last thing I want to talk about, leveling up on your legal protection and your asset protection. Yeah. And I'm sure KKO has told you this, but like it's something you should revisit every single year.
Yeah.
You don't have to be on top of it every single day.
Yeah, because you're gonna have new properties probably every year.
You're gonna have new properties,
sell something.
Change. You want to maybe move this one into this one where it makes more sense. Take a look at it once a year. Sit down with an attorney, pay the $500, sit down with them and see like how can we optimize this for the best year going forward. That's all I wanted to say.
So that was a big tip. That was tip number 6, leveling up your asset protection and legal structure. Tip number 7, start raising private capital or partnering strategically.
Okay.
So this can help with, instead of just getting a hard money loan or a bank loan every time you need a deal and you got to bring in the down payment, over the course of you doing this, you're probably going to run into friends by networking or posting on social media or something. People may eventually come up to you. It's not completely uncommon and be like, hey, I've got $100,000. If you ever want to invest in something, maybe, include me. Yeah. That happens.
It does.
And it's nice to have those unofficial lines of credit with friends and partners, and don't be afraid to venture into being more of a capital raiser when you don't need it. That way it's there when you do.
Yeah. It's always nice to have your sources around, like who can I count on to maybe go in on this deal with me that could benefit from it.
I'd also recommend going to your bank and trying to get a business line of credit. Yeah. Those are amazing. Yeah. Those help me out so much. And it's amazing to be able to constantly pay it down and use it whenever I need it. That way I'm limiting the amount of interest that I pay annually.
Yeah. There's this, I say kid on Facebook that I'm friends with, but he has a really cool system. So he gets all these like business lines of credit and he does his flips with them. And then when he pays them off, they're all 0% interest for introductory 12-month or 24-month or whatever. So he's like, hey, I've still got 20 or 12 months on this 0% interest. Who wants to partner on a loan with me? Or who wants to partner on a thing? Who's got a deal that I can go in and you can do the work and I can reap some benefit? Like, I love that.
Nice.
Yeah.
Yeah, that's a good idea. So that was an easy one. And then number 8, exit strategy. So what's your legacy planning going to be? Are you going to keep buying? A lot of people, they get into real estate with a clear plan of, I'm going to do this forever, or I'm just going to buy 10 properties and retire.
Yeah.
A lot of people find out, especially the motivated ones, that like retiring just isn't going to be an option. But what's your exit strategy?
Yeah.
Try to get clear on that, revisit that annually, I would say.
Yeah.
And see, what do you have to do to start focusing on either bringing up your cash flow or selling off some stuff.
Yeah.
I know it's a lot of revisiting. Again, it seems like you're constantly just revisiting what you already have and seeing how you can improve on that.
Yeah.
But it is a good idea, I think, to reflect here and there
I agree.
on, am I going down the right road?
Mm-hmm. Yeah. I think a lot of investors too, right when they get to this point for, exit strategy or legacy, a lot of investors start selling off their portfolio.
Yeah.
Like they can't take it with them when they die. If they have no heirs, they're just like, oh yeah, like sell it to another investor. And
On seller financing usually.
yeah. And then they don't have to worry about the thing because they're still getting the money.
They don't have to manage properties.
They don't have to manage. And a lot of them, portfolios tend to get like really big. Like they stretch. And then they just start kind of simmering back down as people get a little bit older. Like, I don't need all this.
Yeah. I don't need the headaches. I want to retire. I want to go on vacations.
Yeah.
And you can't always do that if you are investing full time. You can if you have the right systems, the right help, the right leverage. But I've noticed with a lot of real estate investors, once they get to a certain age, they tend to just want to shut it all off.
Yeah.
Maybe they're managing too much.
Right. Well, I mean, like take Sean Dolan, for example, and I'm sure he wouldn't mind us saying his name because he's a friend of the show, of course, but like he had 150 doors. Yeah. And he's like, this is a lot. And he sold half his portfolio. 90. Yeah, he sold like a third of his portfolio, and he paid off all of his other loans.
Yeah. So he owns all those like free and clear.
Yeah. It's
pretty nuts.
Yeah.
It's a lot of...
That's the power of real estate,
cash flow.
Like he's just like, 150 is a hard manage. Why don't I just sell a quarter of them and pay off my other notes? Pretty cool.
Pretty cool stuff.
Pretty damn cool.
All right. What'd you guys think? Are they okay tips? I'd like your feedback.
Like I say, what do you guys think? We're not live right now.
Well, I mean, for those that are going to make a comment, because there's nobody does that anymore.
Yeah.
Nobody comments on
Rest in peace to our comments.
Rest in peace comments. We never get those anymore.
Yeah, no, thank you so much for listening to the Investor Shed podcast or watching if that's your the way you choose to partake. We love you. I love you more than Nick does.
That's for sure.
Yeah.
Yep.
And we'll see you next week on the Investor Shed podcast.
Bye.
Thank you so much for checking out the Investor Shed podcast. If you enjoyed your time, make sure to leave a 5-star rating and review on Apple Podcasts and Spotify. Follow along on YouTube, TikTok, and Instagram at The Investor Shed for shorts and promos about each episode. Do you want to be a guest or know someone who has great real estate investing advice and stories? Reach out to us at theinvestorshed@gmail.com.